You're listening to this article from Convertz.app. How to read crypto charts. Technical analysis basics for beginners. Why learn to read charts? Whether you are actively trading cryptocurrency or simply holding assets long-term, understanding how to read price charts gives you an edge. Charts are the language of the market. They tell you what buyers and sellers are doing, where key price levels exist, and whether momentum is building or fading. You do not need to become a full-time technical analyst. Even a basic understanding of charts will help you make better decisions about when to buy, sell, or hold. Candlestick charts, the foundation. Anatomy of a candlestick. The most common chart type in crypto is the candlestick chart. Each candle represents a specific time period, 1 minute, 1 hour, 1 day, etc., and shows 4 pieces of information. Open, the price at the start of the period. Close, the price at the end of the period. High, the highest price during the period. Low, the lowest price during the period. Green or white candles, the close was higher than the open, price went up. Red or black candles, the close was lower than the open, price went down. The thick part of the candle is called the body, and the thin lines extending above and below are called wicks or shadows. What candles tell you? Long green body, strong buying pressure. Long red body, strong selling pressure. Long upper wick, sellers push the price back down from the high. Long lower wick, buyers push the price back up from the low. Small body with long wicks. Indecision, neither buyers nor sellers are in control. Key candlestick patterns. Doji, a candle where the open and close are nearly identical, creating a cross shape. This signals indecision and potential trend reversal. Hammer, a small body at the top with a long lower wick. Appears at the bottom of downtrends and suggests buyers are stepping in. Bullish signal. Shooting star, a small body at the bottom with a long upper wick. Appears at the top of uptrends and suggests sellers are stepping in. Bearish signal. Engulfing patterns, a large candle that completely engulfs the previous smaller candle. A bullish engulfing, large green after small red, at support suggests reversal upward. A bearish engulfing, large red after small green, at resistance suggests reversal downward. Support and resistance. What they are. Support is a price level where buying interest is strong enough to prevent the price from falling further. Think of it as a floor. Resistance is a price level where selling interest is strong enough to prevent the price from rising further. Think of it as a ceiling. How to identify them? Look for price levels where the price has repeatedly bounced, support, or been rejected, resistance. The more times a level has been tested, the more significant it is. When support is broken, it often becomes resistance. When resistance is broken, it often becomes support. This role reversal is one of the most reliable concepts in technical analysis. Applying support and resistance. Buying near support gives you a favorable risk-reward ratio. Your stop loss is just below support. Selling near resistance captures gains before the price potentially reverses. Breakouts above resistance can signal the start of a new uptrend. Breakdowns below support can signal the start of a new downtrend. You can check current prices and spot key levels on Convertz.app's crypto pages. Moving averages. Simple moving average, SMA. A moving average smooths out price data by calculating the average price over a specific number of periods. The 50-day SMA and 200-day SMA are the most widely watched. When the price is above the moving average, the trend is generally considered bullish. When below, bearish. The golden cross and death cross. Golden cross. The 50-day SMA crosses above the 200-day SMA. This is a bullish signal suggesting the start of a potential uptrend. Death cross. The 50-day SMA crosses below the 200-day SMA. This is a bearish signal suggesting the start of a potential downtrend. These signals are lagging. They confirm trends after they start, but are widely watched and can become self-fulfilling prophecies because so many traders act on them. Exponential moving average, EMA. The EMA gives more weight to recent prices, making it more responsive to new information. The 12-day and 26-day EMAs are commonly used for shorter-term analysis. RSI, Relative Strength Index. What it is? RSI is a momentum indicator that measures the speed and magnitude of recent price changes. It oscillates between 0 and 100. Above 70, the asset is considered overbought, potentially due for a pullback. Below 30, the asset is considered oversold, potentially due for a bounce. Between 30 and 70, neutral territory. How to use RSI? RSI is most useful for identifying potential reversal points. If Bitcoin has been rallying and RSI reaches 85, it does not mean the price must fall, but it suggests the rally is stretched and a pullback is more likely. RSI divergence is a powerful signal. When the price makes a new high but RSI makes a lower high, it suggests momentum is weakening even though the price is still rising. This bearish divergence often precedes pullbacks. Volume. Why volume matters? Volume shows how many units of an asset were traded during a period. It confirms or questions the validity of a price move. Price up plus high volume, strong buying conviction. The move is likely genuine. Price up plus low volume, weak conviction. The move may not be sustainable. Price down plus high volume, strong selling pressure. The decline is likely to continue. Price down plus low volume, selling may be exhausting. A bounce could be near. Volume spikes. Sudden spikes in volume often indicate important market events, big news, liquidation cascades, or institutional activity. Always pay attention when volume suddenly increases, something significant is happening. Putting it all together. Technical analysis works best when multiple indicators confirm the same signal. Here is a simple framework. Number 1. Identify the trend using moving averages. Price above 50 SMA equals uptrend. Number 2. Find key levels using support and resistance. Number 3. Check momentum using RSI. Is the market overbought or oversold? Number 4. Confirm with volume. Does volume support the move? If the trend is up, price is near support, RSI is oversold, and volume is decreasing on the dip, this is a high probability buying opportunity. If the trend is down, price is near resistance, RSI is overbought, and volume is weak on the bounce, this is a high probability selling opportunity. Common mistakes to avoid. Using too many indicators. More indicators mean more conflicting signals. Keep it simple with 2 to 3 core tools. Ignoring the larger time frame. A bullish signal on the 5-minute chart means nothing if the daily chart is in a strong downtrend. Confirmation bias. Do not cherry-pick indicators that support what you want to believe. Look for evidence that contradicts your thesis. Forgetting fundamentals. Charts show you what the price is doing, not why. Major news events can override any technical setup. No risk management. Even the best setups fail. Always use stop losses and never risk more than you can afford to lose on a single trade. Disclaimer. This article is for educational purposes only and does not constitute financial or investment advice. Technical analysis does not guarantee future price movements. Cryptocurrency trading is highly volatile and risky. Past patterns may not repeat. Never invest more than you can afford to lose. That's the end of this article. Visit Convertz.app for more guides and free conversion tools.